Hello, I'm Sal Maratone. I'm here with Dan Beniak. We're part of Treasury Partners portfolio management team, and we're back for a monthly fixed income review. Dan, inflation remains subdued. Unemployment data that we recently got was slowing. And as a result, the market expectations for the number of Fed cuts over the next couple of quarters increased significantly. But Dan, Munis 4.5% for very solid credit ratings. Do those remain attractive? Still available?
They do. And our overarching observation is the window that we've had for the past several months of an ability to lock in elevated long-term rates on both the tax-exempt and taxable sides of the book, it's still open. This past month was interesting. We essentially had a situation where 2 and 10-year treasuries, the short and the long end of the curve, they were gradually increasing as the month went on by 20, 25 basis points or so cumulatively. And then, at the very end of the month, we come to it with a bang, disappointing jobs growth numbers, which cause investors to immediately reassess the prospect of how many Fed cuts are coming, caused the market to give up those 20, 25 basis points right back down. We're right where we started July, essentially, with the 10-year treasury around 420, 425%. But that means that, if we're talking about corporate portfolios, 3 to 10 years or so, laddered maturities with good credits, you can still get 4.5% on average weighted average yields, which are very good yields in our book. Similarly, on the muni side of the book, you still have this persistent opportunity where short-term munis are yielding far less than long-term munis, which are yielding 4.5% after tax. For good structure, good coupon names, you're not really taking any sort of adventures of credit or anything like that, Sal, and you're able to tie up your capital for 7 years plus, which we feel is the right way to go in the situation where we feel the Fed will be cutting. We agree with the market on this. Right. Will be cutting sometime in the next few months. And this is your opportunity to try and take advantage and lock in these yields while they're still available. So we've been doing this for several months now. We're grateful the window's been open. We'll be able to deploy cash, rotate out of some lower yielding positions into higher yielding positions where possible in client accounts. It's really allowed us the time to really act on this opportunity as best as we can. We're sticking with our knitting here, Sal.
Great. Thanks for joining us.
Thank you very much. See you next month.